He should be focused on the fact that we had a shock that pushed inflation up and growth down. And that's a bad supply shock. That's a self-inflicted wound. And it tells us that policy is moving in the wrong direction. And it's a shot against the bow of the Trump tariff policies, which clearly have materially changed the picture in a way that the Fed is seeing both as more uncertain and more problematic on both their key objectives.
I was struck by the fact that in the projections, the growth projections were taken down, not just for 25, but 26 and 27 as well. On the inflation side, it was really mainly in 25, and you heard Chair Powell say maybe the effects are transitory, using that word we've heard before.
I would have thought the chairman would retire the word transitory. That is perhaps the most notoriously ill-chosen phrase of his excellent 7.5-year run as Fed chair. And so I was astonished to see him resurrect that concept. He might turn out to be right, particularly if the economy suffers a recession. It's conceivable that the economy won't suffer a recession and he'll turn out to be right. But it's certainly not something that I would want to bank on. There's another point that I think most observers have missed, which is if you look at the dot plot, the median, the person in the middle on interest rates, has not changed. That's what everybody's highlighted. But the average, if you just take an average of everybody's forecast, that's moved up a fair amount in the last few months, reflecting the fact that with these tariffs, with the inflation they're bringing, there's less confidence on the part of the Fed that they're going to be able to cut rates, even as there's a prediction of more cyclical weakness in the economy. So this is clearly a more worrying picture than we had in December, and there's only been one important change, and that's been the change in tariff policy and more broadly, the political approach to economics.